Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, bringing you another one of my videos where I'm going to be offering some lessons in valuation. They call me Mr. Valuation because I believe valuation is critical. There's a lot of nuances to valuation that need to be understood. And so the title of this video is going to be talking about two companies that had significant stock price drops over the last couple of years. But the title is, Not All Price Drops Are the Same, because fundamentals matter and they matter a lot. And the other fact is that the market often misappraises the value of a business. But here's something I'm going to be focusing on and highlighting throughout this video. And when stock prices are significantly overvalued, people tend to ignore that. They don't worry about that. Investor psychologists have taught us that people are 2.5 times more susceptible to fear than they are greed. In other words, to price drops than they are to overvaluation. When stocks are really high, people tend to ignore that. When stock prices drop, the world is coming to an end and people get all giddy. And one of my major goals is to get people to focus on the intrinsic value of the businesses they own and not worry about what the stock market may be pricing it at in the short run. So let's go ahead and look at two companies that I've been asked to update. Okay, I did short videos on these, at least one of them here in the past, and I did a full video on the other. But the first one I'm going to look at, let's go to FastGraphs and go ahead and look at the fertilizer company, FMC Corporation. Now, I want to make a couple of points here. I'm going to take price off of this graph. And I talk about fundamentals matter, and fundamentals matter a lot. Okay, this is a plotting of adjusted operating earnings here. And this is adjusted operating earnings going back to 2005. And you could see it grew very nicely through even the Great Recession of '08. They had a negative down year in 2015. Then they had a couple of, I'm going to call modest years in 2015, 16, and 17. Then they had a little growth spurt here. And then more recently, we've had a collapse of like 4 or 5 years in a row, including estimates. And that light green shade is estimates. Now, there were some reasons for all this. Number one is the company did have the departure of Mark Douglas, who was the CEO of the company, and the board essentially felt that he was not steering the company properly. There was collapses in earnings and massive write-downs on an India business that they had that they lost money on, and a sharp drop, obviously, in the company's stock price, which I'll bring here in a moment. So this leadership change was seen as a part of a big, broader restructuring effort as the board and shareholders sought new direction and accountability. Now, it looks like fundamentals have begun to stabilize and are even expected to begin growing again in the future. Okay, and I'll talk about that some. But let's talk about what happened to the price. Now, I often say earnings drive market price. One of the beauties of FastGraphs is it draws a picture of the business behind the stock. That's what the orange line on the graph is. You can see a lot of cyclicality here. And the gold line here is the dividend, and you can see where they slashed the dividend from $2.32 to 32 cents. They cut $2 out of the dividend. They flattened it for a couple of years first, and then they slashed it dramatically. And now looking at some other metrics here. Well, before I do, let's put price on here, because I want to make this point. These are weekly closing stock prices. Now, what you clearly see here is the evidence. FastGraphs provides the absolute evidence about validating the principle that earnings drive market price. You can clearly see when earnings were doing well, the stock price did well. There's always going to be short-term volatility because that's the emotional side of the market. And that's really the short-term volatility that gets people in trouble. But look how the earnings, when the fundamentals collapsed, the earnings collapsed, then earnings exploded and the company's stock price exploded, and then it settled. But then we had this high volatility here during these couple of years where we had some 12%, 2%, 12%, 7%. So you had some, we'll call it volatility in the growth rate. And then in 2023, you had this, we'll call it 50%, 49% collapse in earnings from 741 to 378. And look how the stock price reacted to that. And then we've had a couple of more years, and now the stock price, and especially lately in more recent times, the market's, I'm going to say, been bruised a little bit. The psyche of the market's been bruised a little bit, and stock prices are overreacting. But I want to make a point. We had an 8% drop in earnings in 2024 after the 50% drop. We had a 14% estimated drop for this year, followed by an expected 5% drop in 2026 before we start to see analyst expectations of a recovery. All right. But this is a significantly more dramatic drop in stock price than we've seen in fundamentals. Fundamentals would warrant, or at least indicate, a price in the $45 range, and the price is currently $14 a share. Okay, that's putting a 15 multiple on expected earnings. All right, but let's look at some other parts of the company. From a standpoint of operating cash flow, this company's had some pretty erratic operating cash flow at times. It is, as I mentioned, a cyclical company where the operating cash flow was not covering the dividend. And then the all-important free cash flow to equity really collapsed and disappeared in 2023. And of course, that led them to ultimately cut the dividend as we had free cash flow performing very poorly. But now we're expecting free cash flow to recover. Okay, from a sales point of view, I want to make this point. The sales picture was a lot more benign. The company did have dropping revenues, but nowhere near as dramatic as we saw with operating cash flow and where we saw with adjusted operating earnings. But the point I want to make is when the price dropped from these highs, we had overvaluation contributing to that. The stock at that point was 24% overvalued. Then it got overvalued again just a year later, basically. And then we had this severe drop in earnings, and we had this 50% drop in earnings, 49% drop in earnings, 50-ish%, because again, if I dropped it from fair value, it'd be about 50%. This was completely understandable and completely illustrated here by fast graphs where fundamentals and price both dropped. So regardless of what the valuations were here, these were valuations of dropping earnings. Then earnings continued to drop, and of course, they began to settle a little bit. But as they continue to drop, as I mentioned, the market is now spooked. And so from the peak values up here, it's not the pure top, it's close enough, to the current valuations. We had a 75%, actually it's worse than that. Let me try to hit it as close as I can here. We had an 89% drop in value, okay? But you also had we'll call it a 57, 67. You had about a 70-some% drop in earnings. So the drop in price was steeper than the drop in earnings, but it was consistent, and this graph clearly validates the relationship between earnings and market price. In other words, it was fully understandable. Now, I did videos in the past on FMC, and FMC was forecast to do better. So if we go to the forecasting calculators and look at the analyst scorecard, we see that the analysts were missing estimates by a reasonable margin of error through 2022, but then they missed the estimate by over 50% in 2023, followed by 20%. This is the one-year estimate, okay? And that's what you see here. That was a 27% miss. Prior to that, it had a pretty decent scorecard where we only had one major miss, and that was in 2015. When you look at the two-year forecast, the number's actually even worse. This is even giving it a 20% margin of error, but we had a 58% and a 63% miss in 23 and 24. Those are big misses. And of course, there were a lot of reasons why that happened. The company had a business in India that they wrote off. They took over a $500 million charge on it. And so we've seen these sharp revenue declines, the negative cash flow I talked about, and these stock price drops, all because fundamentals were deteriorating and deteriorating quite a bit. Okay, it was clearly illustrated by this historical graph. All right, but what I want to point out here is when I say not all price drops are the same, in this case, you have a collapse of fundamentals, a significant collapse in fundamentals, coupled with a significant price fall in price. Now, people wanted to blame fast graphs. Fast graphs gets our data from FactSet. You'd have had the same data from Standard & Poor's and FactSet and all the other data providers, because you can see I illustrated when I showed you the scorecard how big the misses were. That was because they had to take this strong write-off in 23 and 24 in their India operation, over a $500 million write-off. And then they had this leadership change where the long-term Douglas, who was with the firm a long time, I don't know this company real well, so I want to make that clear, but he was basically run off because of the poor operating performance we see here. And that's made analysts very cautious with their estimates in recovery. But what are the opportunities for this company? Now, there are those that believe that if management can execute on restructuring and cost savings and their new product launches gain traction, because the company does do quite a nice job with R&D, they could rebound strongly from current lows. But I don't think you're going to see that instantaneously. But if they started to grow earnings by double-digit rates in 2027, and management's already pointed out that these 2 years, this year will be over in a quarter, to a couple of months, and then they do expect 25 and 26 to be modestly down years, down over 13% this year, this fiscal year. But then they do expect a pretty strong recovery, and I don't know if we got a long-term growth rate here. But no, we really don't. It's a negative growth rate. So the bottom line is this would have to be a recovery situation, and that would be an opportunity. So the question is, if you're an investor in this stock, should you add money at this level? Well, I do think most of the downside is probably already built in. If the stock did end up growing earnings a little bit in 2029, there could be a strong upside to the stock. Now, analysts are all over the place on what they are as far as forecasting what they think the value of this business is. UBS, for example, the last I checked, had a hold rating with a $17 price tag. RBC Capital, 17 as well. Morgan Stanley puts it at 38. That's close to what FastGraphs would be showing here. That would be 38 right here. That would be 13 and a half times future 2026 earnings. The consensus on this is with about a $35 price tag, which again would be somewhere in this neighborhood right here. That potential, if we just go here to the end of 2026 and look at a $34 price, that would be more than a doubling of the stock in a year from these levels. That's very feasible if, and the big word here is if, all these things happen. So bottom line is I see FMC at a critical inflection point. The company's fundamentals have clearly deteriorated, declining revenues, negative cash flow, and the company does have a lot of leverage, I might point out. But if they can stabilize their operations and deliver on their recovery plan, the stock does offer substantial upside from these very depressed levels here. But there's a lot of risk in that. The risk remains extremely high, especially the risk of execution, leverage, and legal issues. So investors should monitor progress on restructuring, cash flow recovery, and market stabilization very closely before they make a decision. But so why did their earnings drop so much? The most direct answer I can give you is FMC's earnings decline in recent year was driven by a convergence of company-specific restructuring actions, noticeably their project focus and major business divestitures, significant one-time charges, especially related to their India business, and persistent industry headwinds such as channel destocking, pricing pressure from generics, weak farmer demand due to falling commodity prices, and other factors. And all these factors resulted in lower revenues, as I pointed out, negative free cash flow, and large net losses, particularly in 2024 and 2025. Now, FMC has undertaken a sweeping restructuring program, incurring large severance costs, asset write-offs, and professional service costs. This included workplace reductions, facility closures, and supply chain optimization. The sale of their GSS business and the India commerce business led to significant one-time charges in revenue losses, impairment and write-downs, especially in 2025. The India business, as I've previously stated, write-down alone caused a $510 million charge and a 49% drop in revenue in the third quarter. So that led to a dividend cut and a debt focus. To preserve cash, FMC reduced its dividend, and then they prioritized debt reduction, which would be a positive thing. Okay, but the bottom line is if you're looking for recovery here, you would have to be very, very patient. I don't see anything happening imminently, but there is a possibility that the market will come to its senses and realize they've driven the price down to just ridiculously low levels here based on valuation and fundamentals. But there is risk to that statement. Okay, their earnings decline in recent years as a result of what I mentioned already, of what I'd call a perfect storm. Aggressive internal restructuring and asset sales, major one-time charges, notably that India charge I talked about, and persistent industry headwinds such as pricing pressure, channel destocking, and weak farmer demand. While these actions are intended to position FMC for future recovery, they have caused substantial short-term financial pain, including large net losses, negative free cash flow, and reduced revenue and earnings guidance. All right, the dramatic drop in earnings is not due to a single factor, as I pointed out, but rather a combination of strategic restructuring, market-specific challenges, and unfavorable industry conditions. Now, management is responding. They have put in an aggressive restructuring and cost-cutting program. The goal is to streamline operations and achieve $125 to $150 million in annual cost savings. That's according to management. A manufacturing redesign. They're redesigning their manufacturing footprint to improve efficiency and reduce fixed costs, even if it means incurring significant one-time charges in the short run, which we've already seen. They have asset divestitures and portfolio simplification. The divestiture of non-core businesses. They sold their global specialty solutions business and prepared to divest their India commercial business, which was costing them a lot of money in the first place. As a result, they've had write-downs and impairments, and they took large impairment charges, particularly related to the India business, to reflect the reduced value of these assets and to clear the balance sheet for a fresh start. So bottom line is, with financial discipline and cash preservation, the company could improve going forward, but it's going to take time. It's not going to happen overnight. So the leadership of FMC has emphasized a renewed focus on innovation, sustainability, and crop protection markets, aiming to position the firm for long-term once the restructuring is complete. But again, they have to complete that restructuring before this all happens. In short, FMC's management responded to the earnings crisis with aggressive restructuring, asset sales, cost-cutting, and a renewed focus on core strength. Of course, that caused that killed their stock price. They prioritized cash preservation and debt reduction, even at the expense of the short-term pain that we've already seen, and communicated more candidly with investors about the challenges that they face going forward. These actions are typical of companies facing severe earnings declines and are hopefully designed to stabilize the business and lay the groundwork for future recovery. But my point is, I think investors would have to have a real strong stomach for risk to be able to lay their money down. I don't think there's really a lot of downside left in the stock at these levels, other than short-term downside. Let's actually look and see how the company's performing today. Let's go to Yahoo Finance. The stock is down another 4% today. It's down 59 cents to $13.60. So apparently the pain here is obviously not over yet. Okay, but I'm going to summarize this part of the video by pointing we had overvaluation contributing to the drop in price. Then we had collapsing fundamentals, which were the main culprit to the drop in price. So this large drop in price was a function of overvaluation, collapsing fundamentals, and then an overreaction, in my opinion, by the market, which drove the stock price far lower than the fundamental deterioration, as severe it was, even indicated. So not all price drops are the same. So let's move on to Fiserv. Now this is a very interesting story here, because now a couple things. This stock doesn't pay a dividend. This is pure growth. And as you can see, the stock price tracked earnings, and earnings were stellar for all these years coming up into 2024. Okay, and then what we had was a 3% drop expected for this year, followed by another 3% drop in 2026. But then analysts are forecasting a recovery, a double-digit recovery for 2027. And the company has talked about double-digit, well, they're talking about high single-digit sales growth and then double-digit earnings growth in the longer run, with the exception of 2025 and 2026, and really starting in 2027. Now, what is the primary difference here than what we saw with FMC? The first thing, I want you to see the points about high valuation. Coming into COVID, which is this gray area here, Fiserv got extremely overvalued. The market's got a PE on it of under 8 now, and back in December of 2019, just 4 or 5 years ago, they were valuing it at 29 multiple. But then once they valued it that high, we went through this sustained 3-year period where you'd have actually lost money owning the stock, even though we had spectacular earnings growth. The idea that the market misappraises stocks, but people don't seem to worry when the market is overvaluing a stock. They don't panic and get all emotionally dissettled and disgruntled as we see with stock price drops. Then the stock all of a sudden had a couple of good years, but even not as good as some of the years that caused the price to drop because of the high valuation. But we had a good valuation coupled with some good operating results, and we saw this ridiculous, in my opinion, overreaction and rise in stock price. And people don't relate to it. We had 112% growth in the stock price, and we had about 30%-ish growth in the fundamentals. But then once the fundamentals flatten, when you have a stock price this highly above the earnings justified level, which is what that orange line is, they become very vulnerable. So the first thing I'm going to say, looking at the stock price from top to bottom, well, this was a 47% drop in price when it came down to what I'd call fair value with maybe a little sentiment. But the actual drop in value of this stock, and I'm having trouble hitting these periods perfectly, but we had over a 70% drop in the value of the stock price. But the majority of that drop, just want to be clear, the majority of that drop was actually a function of overvaluation. Over 40% roughly was annualized, over 50% was a function of just the stock coming into fair value. And now we've had this significant drop and the earnings, the company keeps dropping. Let's see what it's doing today. It's down another 1% today. But here's my point. When I say not all price drops are the same, we do not have the fundamental deterioration in Fiserv that we saw with FMC. Okay, now Fiserv's recent earnings weakness and sharp stock price decline stemmed from, in my view, a combination of some operational missteps, over-optimistic growth assumptions. Let's look at the forecasting chart, and let's look at the analyst scorecard. And they had some really high growth estimations here, and they weren't able to hit those, all right, as analysts wanted to see. But they weren't bad. We're only talking a 3%. We're talking about a flattening of earnings more than we are a collapsing of earnings, all right? So the Fiserv's earning deterioration in 2025 was primarily driven by underperformance in its financial solutions segment. They had some flawed growth assumptions, as I pointed out, and a reliance on unsustainable revenue sources. The company's third quarter 2025 results were particularly disappointing, with adjusted earnings missing consensus by over 20% and revenue falling 5 to 8% short. But let's go ahead and let's look at revenue here. Let's look at sales and see what's been going on with sales. The picture on sales is actually a lot better. It's actually positive every year. There's no negative growth in sales. Again, this high valuation, in my view, was a primary reason why the price fell down to the orange line at least. And then this is simply an emotional reaction, going from the orange line, if you will, to here, this last drop of over 50% is simply an overreaction by the market. But once again, why wasn't people as crazy about the stock price when Fiserv was here? Here they were happy. They loved Fiserv. It was a great business and so on. Now they're all, what's going to happen? Am I going to lose all my money? Everything, the world's coming to an end. Okay, so there's a lot of moving parts of this particular company, but it's been one of the best managed companies that I've ever seen in my career, looking at it historically. There are some people saying that's not true, but I can't buy it. This company has really produced good revenue growth, good earnings growth, and they have had some problems. Most of their recent growth was driven by business in Argentina, where high inflation and interest rates did temporarily boost results. But as macroeconomic conditions normalized, this tailwind faded, exposing what some analysts believe was an underlying weakness in the company's core operations. Management acknowledged that previous growth and margin targets were overly aggressive based on assumptions that proved unattainable even with strong execution. So the company was forced to reset its 2025 guidance, slashing organic revenue growth from 10 to 12% to just 3.5 to 4%, and cutting adjusted EPS guidance by nearly 20%. And of course, that caused this strong reaction in stock price. So why is the stock falling so much? A lot of it was overvaluation, and the other was the revisions in forward guidance, which, remember, investor psychologists have taught us that investors fear the pain of loss 2.5 times greater than the pleasure of gain. So these wild swings in valuation, which were as the market was as wrong here as I believe it's as wrong here. This company did deserve to have a reset of its price, but I think down to this level here. I think this is all overreaction in my view. Okay, and so we're looking at 5-year lows on the stock price now, and this was all triggered by the magnitude of the earnings miss and the abrupt downward revision, as I mentioned, of forward guidance. Okay, institutional investors responded by modestly reducing their positions, but they didn't totally leave the company. And the company's, obviously, valuation multiples have now compressed sharply, and it's basically a situation where the real question is, a value investor for growth, is this a long-term opportunity now? So, in conclusion, Fiserv's recent earnings weakness and stock price collapse are the result of both internal missteps, such as underinvestment, flawed growth assumptions, and over-reliance on unsustainable revenue sources, and external fintech sector headwinds. But the company is now in the midst of a strategic reset with management focused on long-term health over short-term results. So while the next 12 to 18 months are likely to remain challenging, as clearly illustrated by the fast graphs from at least a fundamental point of view, the company is now in the midst of a strategic reset with management focusing on this long-term health over short-term results. Okay, so Fiserv's strong market position, innovation pipeline, and operational overhaul do provide, in the view of many analysts, a credible foundation for recovery and renewed growth by 2027. All right, investors should expect a gradual multi-year turnaround with the greatest upside coming in the client service business. Now, a lot of this depends on what they call their Clover platform. Okay, and the Clover platform is their flagship point of sales and business management platform, which is primarily offered and designed for small and medium-sized businesses. It provides merchants with hardware like payment terminals and registers, and a cloud-based software ecosystem that handles payments, inventory, employee management, analytics, and customer engagement. Its open architecture is also a plus because it allows third-party developers to build apps that extend its functionality, making it a flexible operating system for e-commerce. So Clover's value proposition is its all-in-one approach. It enables businesses to accept payments in-store, online, and even mobile, and manage daily operations, access marketplace of business apps. And over the past several years, Clover has become a central pillar of Fiserv's growth strategy, with ambitions to rival or surpass competitors like Square in the small, medium-sized business space. So how does Clover look going forward? Short-term outlook are mixed. The platform has faced headwinds from increased competition, merchant churn, and some client dissatisfaction related to recent fee increases and service issues. These challenges have contributed to Fiserv's recent earnings weakness and forced management to reset growth expectations. In the immediate future, Fiserv is prioritizing investments in Clover's technology, customer support, and partner ecosystem to stabilize the platform and restore merchant confidence. The medium to out-term lookout, this would be 2027 and beyond. Despite current challenges, the long-term outlook for Clover remains very promising. Fiserv's new management team has made Clover's revitalization a top priority. They're offering product innovation, ecosystem expansion, international growth, leveraging Fiserv's global reach, a client-centric focus, etc. So Clover is Fiserv's all-in-one point-of-sale and business platform for small businesses. And again, they offer payments and app integrations, etc. And if those things manifest, we could have a very significant upside in the stock. But you are going to have to go through a period of at least the next 15 months or so of probably some negative results and negative reports. I do think the stock price has fallen way beyond what earnings would justify, just like the stock price went way above what earnings justified by February of 2025. Here we are in November, or October, November we'll call it, of 2025, and we're seeing the exact opposite, but similar overreaction by the marketplace. So in summary, not all price drops are the same. In FMC's case, it was a completely rational price drop up until this last trounce down, which is just a collapse in investor sentiment and could indicate a buying signal. But this was a case where the fundamentals and the stock price both fell precipitously. In the case of Fiserv, we see a company who had weakening fundamentals, but only modestly so. We're still looking at the second and third most profitable years in the company's history for 2025 and 2026. Hardly a disaster, but the stock price clearly is acting like it is a disaster. So anyway, that's my update on Fiserv and FMC Corporation, two stocks that viewers on my YouTube channel have asked me to cover. I am a follower of Fiserv. I've never really followed FMC. I have showcased it in videos before, but the point I want to really make here is there never is a substitute for comprehensive, ongoing research and due diligence. I think as John Maynard Keynes said, when he was asked by a reporter why he changed his mind on a certain issue, his retort was, and I'm paraphrasing, "When the facts change, I change my mind. What do you do, sir?" And I think that's the point. That's why you have to watch. What happened to FMC came out of left field, and it was a major collapse. What happened to Fiserv also came out of left field, but it was more minor, but yet both stocks suffered significant price volatility. Major overvaluation was more than half of Fiserv's problem, and fundamental collapse was most of the FMC problem. So anyway, I hope you enjoyed this video, and I hope it made sense to you, because not all price drops are the same. And the beauty of fast graphs are that they really give you the real evidence of how stock prices and fundamentals operate in the long run. If you enjoyed the video, give me a like, ring the bell. And of course, if you haven't subscribed to Fast Graphs and you invest in stocks, you ought to take a look at it, because I consider it the value investor's best friend. Thanks for watching, and we'll talk to you again in the next video.